the Volcker Rule. Now, the Volcker Rule was part of Dodd-Frank. It's supposed to ban proprietary trading. That's where banks speculate with your money, with customer money, to make a profit for themselves by taking huge risks while doing it. The problem with it is when too big to fail banks do this and something goes wrong and they're highly leveraged, they could get wiped out. Only they won't get wiped out, will they? Because they're too big to fail, so they'll be bailed out by you and me. Now, Wall Street is fighting the Volcker Rule tooth and nail, and you can imagine why. But even without Wall Street fighting it, the 530-page monstrosity of a bill allows for plenty of loopholes, according to critics, as you can imagine, in 530 pages. Now, they've been outlined by the financial activist group Occupy the SEC, which wrote a 325-page letter to the agency in charge of regulating Wall Street, which is what the SEC is. Now, to set this all up, one of the loopholes in this Volcker Rule comes in the form of a market-making provision. Let's remember market-making for a second. Here's Lloyd Blankfein talking about it when Charlie Rose asked him if Goldman Investment Advisors had ever bought securities from the firm, sold them to clients, and then bet against those same securities. And note Blankfein's pregnant pause.
I have to explain. See, this is a problem. As a market maker, we are making buying and selling 1,000 times a minute. Of course, probably. That's the.
Probably. We're just market makers. Now, another one of the provisions has to do with hedge funds. The Volcker Rule is supposed to make it so banks can't own hedge funds. Let's remember why. Okay, here are some headlines from the financial crisis days. BNP Paribas freezes funds as loan losses roil markets. These were their investment funds. And here's another one. Bear Stearns hedge funds wiped out. So Bear had to pump more than $1 billion into those hedge funds, and they ended up going bankrupt. Now, the problem, of course, is there are exceptions to the hedge fund part of the Volcker Rule. We're going to get into all of this. Here to really break this down, Alexis Goldstein. She's a former Wall Street technology VP and member of the Occupy the SEC. And Caitlin Klein. She's a former derivatives trader, also a member of Occupy the SEC. Ladies, thank you so much for being here. I'm so excited to talk to you about this. You guys have done such good work on this issue, and I really look forward to breaking it down.
Thanks for having us.
Absolutely. So let's get into this, because before we get into dissecting the letter that you guys came up with, you are a group of financial professionals, former financial professionals, lawyers, who came together and came up with a 325-page letter that responds directly to the SEC, along with efforts by the nation's largest banks to water down this legislation. First, before we break it down, just give our audience a synopsis of what you're trying to achieve here.
So what we were trying to do is to shine a light on this part of the process where the media usually takes a step back. Here in the U.S., we usually see a big spotlight on the actual drafting of the law, and people will pay attention during that phase. But some of the most important parts happen when the law becomes a regulation. There's this thing called the Administrative Procedures Act that allows the general public to comment on drafts of regulations before they become final. And that's really where the banking lobby tends to dig in and try to water down rules to their liking. And so what we were trying to do was to draw attention to that process and also to provide a different voice, something that's going to say quite a bit different than what the banking lobby says, to try and make the rule stronger rather than weaker.
Yeah, quite a bit different. So let's get into some of those aspects and the loopholes that you point out. We can't obviously dissect the 325 pages, but there are a couple key loopholes that we want to point out that are really important, and feel free to add later in the interview. But one is the market-making loophole, because after the financial crisis, we heard this term thrown around a lot. We heard Lloyd Blankfein talking about it in my setup, defending the firms, defending the kind of trades and deals we saw, like Hudson, like Timberwolf, which were key examples of banks profiting at the expense of their customers and the economy, all during the financial crisis. So talk about the market-making provision and what the problem is with it and how it allows people to get around the very spirit of the Volcker Rule.
Right. So, when they went to pass this law, there was this kind of overarching theme that market making is this very important service and it provides liquidity to functioning markets, and this is something that really needs to be protected within the banks. And the way that they describe it a lot in the law, has all of these qualities of very liquid securities like exchange traded equities or treasuries. And the market making is pretty straightforward when it comes to those kind of securities. Where it becomes a little bit more tricky is as things get less liquid and more structured, like over-the-counter derivatives and kind of structured products. And these things have a really high potential to disguise proprietary trading and require banks to take on a lot of proprietary risk. They're also really difficult to monitor and for regulators to come in and say, we can tell that you're doing this on behalf of a client and not for proprietary gain. So as they get less and less liquid, there's more and more of an opportunity for these banks to really get into kind of some murky water with these positions. So it turned into a pretty big loophole for something that should have been a very kind of straightforward, risk-free kind of client servicing enterprise.
So right now, banks can basically do, under this version of the Volcker Rule, exactly what they were doing before because they can still be market makers.
Right, and there's kind of this ability to say, oh, I'm making a market, right? I've created this structured product that I'm going to go out in the market with, but I'm making a market. And, you know, these are not the definitions. This is not what it was intended in the rule. It's kind of this extension of the banks trying to say, we want to be able to continue doing the business that we were doing, so we're going to effectively call, you know, structured origination, and we're going to call that market making, and it doesn't make a lot of sense.
And you're getting to this issue of language, and so I want to continue this with another term that we hear a lot, which is hedging. And it's another excuse we've heard from the banks that they're not engaging in proprietary trading. They are hedging their risk, making a legitimate hedging of their bets. This is something you talk about a lot in your letter, and you talk about the way they can get around this language. Can you explain?
Right. So the hedging exemption is just a giant hole, and really the idea of it is, you know, if they're going to be taking on risks in any capacity as market makers, they need to be able to go and offset these risks in the market. And that's a reasonable assumption. That's something we certainly want them to do. The problem is the things that they can call legitimate hedges are any number of trades. There's really any kind of risk. You can say, oh, this is a basis risk, and that's what I'm putting on. That's what I'm hedging. And the potential for them to, you know, you put on any number of proprietary positions, big structure proprietary positions, saying, no, I'm hedging a counterparty risk, or, you know, I'm hedging a basis risk. You know, there's really no specificity in terms of what would be a reasonable hedge. There's a lot of capacity to actually take on a lot of risk in the capacity of hedging. And, you know, that's never what a hedge is something, it should always reduce risk. So, you know, we think that there's a lot of room in that for people to really be putting on proprietary positions instead of reducing risk.
Right, by saying they're just hedging their bets. Now let's talk about hedge funds, because that's another thing that the Volcker Rule is supposed to keep banks from being. And let's talk about the limitation on covered funds, as they're referred to in the legislation. And this just means that they're covered by the regulation. I want to bring up an excerpt from your document, Super 23A. About that, you say, we strongly support the restriction. Preventing banking entities from extending credit to the covered fund is important to ensure that banking entities are not tempted to bail out a covered fund should it falter. Now, Dimitri's going to jump in here to ask a question about that.
Hey guys, so we found this particularly interesting because on the one hand, it does a good job of preventing quarantining the funds that banks may have connections to by preventing them from bailing them out. But on the other hand, it may not go far enough in terms of preventing the larger fund from not offloading assets and risk, and so playing accounting games. How do you see Super 23, this part of the legislation from working, and what do you think about how it could be watered down and how it could be strengthened?
Well, I actually think that Super 23A is quite good. It sort of says, refer to the Federal Reserve Act, Section 23A, but instead of using bank and its affiliate, use bank and their covered fund. And it prevents them from extending credit, and it prevents them from buying assets from the fund. But the problem is there is also an exemption for prime brokerage, which is this separate exemption that is explicitly allowed. So banks that have an ownership interest in a fund can still act as a prime broker. And there's no language saying that if they're acting as a prime broker, they cannot provide financing to the fund. So you can sort of get around this 23A, Super 23A is what they refer to it as, if you're acting as a prime broker to the fund that you have an ownership interest in. So we do think that Super 23A is really good and strong, but we have a big problem with the permitted allowance for prime brokerage. And one of the things that we suggested in the letter is that prime brokerage should not be allowed to finance. So if I'm a bank, I shouldn't be allowed to loan money essentially to someone that that I'm acting as a prime broker for.
And just really in short, there are provisions that would essentially allow them to use what they're allowed to do as far as hedge funds and funds in order to proprietary trade, kind of a shell, right?
Right. I think our main concern with that is a different exemption. So there's an exemption that allows you to hedge a compensation arrangement. So if I'm a bank and I have an employee who's acting as an investment advisor to a hedge fund, normally you're supposed to not be able to own more than 3% of any one fund. But if you have an employee who's acting as an investment advisor, you can hedge their compensation by taking even more than that 3% limit. And there's no limit on how much you can take. It just has to be somehow connected to that compensation arrangement. But because the language is sufficiently vague, we're concerned that they could basically just completely subvert the intent of the rule and say, oh, but it's okay because I'm hedging this comp arrangement and I thought my investment advisor was going to triple the value of the fund that year. So I had to take a 15% ownership interest. And so the language is sufficiently vague, and it also seems to fly in the face of the law. The law said you can hedge positions, you can hedge contracts, you can hedge things that go in the trading account. It didn't say you can hedge compensation.
Right. Okay. Ladies, I want to continue this conversation. We have to go to a quick break, but we'll be back with more with Alexis Goldstein and Caitlin Klein, both members of Occupy the SEC. And still ahead, fresh off bailout approval.